Hey everyone, and welcome back. I am so incredibly pumped you're here for day 5 of our 30-day options trading series. Now, if you've been following along with our recent explainers, you know we've already conquered the basics of call and put options, and honestly, you guys are doing absolutely great. Today, though, we're taking a massive step forward. We're going to break down a concept that literally drives the entire options market. It's a real game changer, so let's dive right in.
Okay, I want you to picture this. You open up your trading screen right now. You type in your absolute favorite stock. Let's just say it's a giant tech company. You look at the options available for that exact same stock on the exact same day, and you see dozens of completely different option prices. I mean, some are super expensive and others are unbelievably cheap. It's the exact same underlying company, the exact same market conditions, so why in the world does the exact same stock have so many different option prices? It's a total mystery, and let me tell you, it trips up almost every single beginner.
Well, the answer to that mystery is strike price. This one simple little term is basically your secret decoder ring to understanding an entire options chain. It is the absolute core focus of today's explainer, and by the end of our time together today, you are going to see exactly how powerful it is to master this single concept.
So when we strip away all that confusing financial jargon, the definition is actually really simple. A strike price is just the fixed price at which you can buy or sell an asset. Think of it kind of like signing a real estate contract. Let's say you sign an agreement to buy a house for $300,000 next month. That price, it's locked in. Even if a massive, fancy shopping mall gets built right next door and the home's value skyrockets overnight, your contract absolutely guarantees you that original $300,000 price. That pre-decided locked-in number, that's your strike price. When you buy an option, you are specifically choosing that fixed reference point.
And this brings us to a brilliantly simple way to think about it. Strike price is your decision level. I absolutely love this quote because it takes a cold mathematical term and turns it into a strategic one. Your strike price is essentially your line in the sand. It's the exact, specific level from where you think the market is going to move. Really, it's your ultimate decision point before you ever even enter a trade.
Let's ground this with a real-world example, right? Because that's the absolute best way to make these concepts stick. I want you to imagine the Nifty 50 index, a major market benchmark, is currently sitting right at a beautifully round number. The market is completely live, the ticker's flashing away, and the current price of Nifty 50 is exactly 20,000. Go ahead and lock that number in your head.
Now, when you pull up your trading app to buy an option on the Nifty 50, you aren't just given one single choice. You're actually going to see a whole menu of options with numbers like 19,800, 20,000, and 20,200. These aren't just random meaningless numbers. These are all the different strike prices available for you to choose from. You can pick a strike price that is exactly where the market is right now, or you can pick one that's above or below that current 20,000 mark. The market is essentially asking you, hey, at what exact price level do you want to lock in your contract?
So what actually happens when you make your choice? Let's say you decide to buy the $20,000 call option. By doing this, you have just purchased the literal right to buy the Nifty 50 at exactly $20,000. You have legally locked in that fixed buying price, completely regardless of whatever absolute chaos happens in the market later on.
Let's play this out and see how it works. Imagine the market drops below your $20,000 strike price, let's say all the way down to $19,500. Well, nobody wants to buy something for $20,000 when they can get it way cheaper on the open market, right? So your option isn't really useful here. But if the market rockets above your chosen level, say up to $21,000, you suddenly have a massive advantage. You hold a contract that lets you buy an asset that's currently worth $21,000 for the incredibly cheap, locked-in price of $20,000. Your strike price literally became your gateway to that profit.
All right, let's do a super quick summary of these 4 essential pillars before we move on to some of the trickier stuff. First, the strike price is a fixed price. It does not change once you're in the contract. Second, it is a level you specifically choose while buying the option. Third, there are a ton of different strikes available to you. And fourth, it is absolutely critical for your profit calculation. Your profit entirely depends on how far the actual market moves away from your chosen strike price. Listen, if you understand these 4 basic points, you are for sure already way ahead of 90% of beginners out there.
Now for the tricky stuff. Let's look at 3 common beginner mistakes, and more importantly, how to avoid them.
Mistake number 1, choosing a strike price randomly. Honestly, you'd be shocked at how many new traders just open up an options chain, see a massive wall of numbers, close their eyes, and essentially throw a dart at the board. Option trading is not a lottery, guys, and your strike price is definitely not a lucky number. It is a strategic decision level. Every single time you pick a strike price, you absolutely need to have a specific, logical reason for why you think the market will move past that specific point.
Mistake number 2 is not understanding the relation with the current market price. Remember our Nifty 50 example where the market was sitting right at 20,000? Well, if the market is at 20,000 today, it makes absolutely 0 sense to buy a call option with a strike price of 30,000 if the contract expires tomorrow. I mean, the market is mathematically highly unlikely to just magically jump 10,000 points overnight. Your chosen strike must always make realistic sense compared to exactly where the market is currently sitting.
And finally, mistake number 3, always choosing cheap options. Man, this is the ultimate beginner trap. Going back to our 20,000 Nifty 50 example, an option with a strike price of 25,000 might cost you mere pennies to buy. But you know why? That's because the market knows it's practically impossible for the index to reach that level in a short time frame. Please don't fall for the illusion of cheapness. You need to choose a strike price that is realistic, not just inexpensive.
Okay, we have covered a huge amount of ground today, and I'm so proud of the focus you're bringing to this series. Before we wrap up, I've got a tiny bit of homework for you. Don't worry, it's the fun kind. Today, I want you to log into your brokerage account, or really any free financial website, and open up an options chain for a stock you follow. Step 2, simply look at the different strike prices. Notice how they're perfectly spaced out. Notice how the actual prices of the options change depending on how far away they are from the current stock price. And step 3, and honestly, this is the most crucial part, just observe. Do not trade yet. Do not risk a single penny of your hard-earned money. Paper trading and just visual observation are absolutely key right now.
Because just observing and studying that option chain safely, that is exactly how you truly start understanding options. You're building that essential muscle memory of how all these numbers interact. So the big question is, are you ready for day 6? We are going to take everything we've learned so far about calls, puts, and now strike prices and start piecing the whole puzzle together even further. Make sure you follow the rest of this 30-day series because tomorrow's explainer is going to be fantastic. I mean, think about it. Now that you know exactly what a strike price is, how on earth do you know which one is the absolute perfect one to choose for your strategy? Well, we'll uncover that and a whole lot more next time. Thank you so much for hanging out and learning with me today, and I will see you in day 6.